In the world of investing, there are a few documents that everyone waits for, and this is one of them, Berkshire Hathaway's annual report. Today, we're going to go inside their 2020 letter to shareholders and really uncover the lessons that are kind of hidden beneath the surface. So let's get right into it. Okay, so the very first thing you see at the top of the report is this just staggering number. In 2020, Berkshire Hathaway reported a net profit of $42.5 billion. That's an almost incomprehensibly large figure.
But here's the thing. That massive number, it's also massively misleading. And if you stop there, you totally miss the real story. A story that, by the way, Warren Buffett himself really wants you to understand. So what's really going on behind that $42.5 billion figure?
Well, let's start by deconstructing that $42.5 billion puzzle. To really get a handle on the true health of the business, we have to break this headline number down into its core pieces. Okay, check this out. This chart tells such a fascinating story. See, according to the accounting rules, that $42.5 billion profit is actually made of four very, very different parts. And you've got to notice the biggest slice, right? Unrealized capital gains. That's $26.7 billion that only exists on paper. It's just reflecting that the stock market went up. And then look at that yellow slice. That's an $11 billion loss. And this is a perfect illustration of why that big headline number is so tricky. Buffett himself says that the capital gains part, the single largest piece of his company's profit, is totally unreliable. He uses the word capriciously, which is great. He's basically saying it's completely unpredictable, driven by the whims of the market, not the actual health of his businesses. So if these huge paper gains are just market noise, what does Buffett think is the real signal? Well, this brings us to what truly counts, how the core business itself is actually doing.
And here it is. This is the number that tells the real story of 2020. So forget the $42.5 billion profit for just a second. The actual money generated by Berkshire's collection of businesses, we're talking railroads, insurance, all that stuff, it actually fell by 9%.
To really understand Berkshire, you have to get this term operating earnings. This is the cash that comes from the real, tangible businesses the company owns. Think of it like their true economic engine, completely separate from the daily mood swings of Wall Street. Here's a super simple way to think about it. The operating earnings, that's like your salary. It's the steady, predictable income you can count on. Those paper gains from the stock market, that's a lottery ticket. It's great if you win, but you definitely don't build your financial future around it. Okay, so let's circle back to that other number we saw in the breakdown, that big negative slice of the pie. This section is about something you almost never see in an annual report, an $11 billion admission of a huge mistake. And Buffett, wow, he doesn't hide from it one bit. In his own words, he just says that ugly $11 billion write-down is almost entirely the quantification of a mistake I made. No excuses, no corporate jargon. He just admits he paid too much for a company. That level of brutal honesty from a CEO, it's just so incredibly rare. So, with operating earnings down and an $11 billion mistake on the books, you're probably wondering, how did Berkshire create any value for shareholders in 2020? Well, the answer lies in their core philosophy. It's all about the long game. Here's another huge number from the report, but this one tells a very different story. In 2020, Berkshire spent nearly $25 billion, not buying another company, but buying back its own stock. So, how does that work? Well, it's actually incredibly simple, but so powerful. Think of Berkshire as a pizza. By using its cash to buy back and basically get rid of some of the slices, the remaining slices, they just automatically get bigger. Your piece of the pie grows without you having to lift a finger. And the impact was really significant. That $24.7 billion investment effectively gave every single remaining shareholder a 5.2% raise in their ownership stake across all of Berkshire's massive businesses. And what's the result of all this long-term thinking? This chart says it all, doesn't it? Since 1965, Berkshire has compounded its value at an average of 20% per year. That's nearly double the return of the broader market. That kind of outperformance is just staggering, and it's the result of focusing on the business, not the noise. And this really brings us to the single most important lesson from this entire report. It's the golden nugget. It's a fundamental shift in perspective. Stop viewing stocks as these flashing tickers to be traded and start seeing them for what they actually are. They're pieces of a real business to be owned.
So this leaves us with a final, kind of provocative thought. In a world that is obsessed with constant action, with trading, with always doing something, could it be that the ultimate financial advantage is found in doing almost nothing at all? Just finding a great business, buying your piece, and then letting the power of compounding do all the heavy lifting for you.